Most trading strategies are a waste of time, not because they don't work, because most people don't actually know how to use them. So in today's video, I'm going to be breaking down a few trading strategies that can actually help you and break down when they work and when they don't work. So let's not waste time. Let's get straight to the video. So first one on the list, let's start with none other than Fibonacci retracement. So let's get straight to an example. Let's just say a stock runs from $10 to $20. Instead of chasing at 20, what people want to know is this. If price pulls back, where could it potentially find support and continue higher? That's where Fibonacci comes in. And the main levels most people pay attention to are these, 23.6%, these 32.2%, 50%, et cetera, et cetera. And now out of all of these, the two most important levels, in my opinion, are the 50% and the 61.8%. Those were the levels where you'll often see the strongest reaction, at least in my personal experience. The way you draw Fibonacci retracement is pretty simple. If a stock is in an uptrend, you draw from the low of the move to the high of the move. And if the stock is in a downtrend, you draw from the high down to the low. And what that does is pretty much show you the key pullback levels inside of that move. And now here's where people mess up. So they use Fibonacci by itself and then expect it to magically predict the market. But that's not how it works. Fibonacci is strongest when it lines up with other things on the chart. And if you're using Fibonacci the right way, you're not forcing trades. You're using it, I guess, like as a map out, possible pullback zones, and then letting price action confirm the rest. Now for the next one, this is one of the most common things traders look for, and it's also the most misunderstood that I personally see from all of my supporters on Twitter, everyone in the Discord. So let me explain it now. A breakout sounds simple. Price reaches a key level, push through, and then it keeps going. But if it was really that easy, everyone would be making money. So the truth is most people get trapped on those fake breakouts because they don't understand what a real breakout actually looks like. So pretty much a breakout happens when price moves above resistance or below support with enough momentum to continue. But the important part is not just a level breaking, it's the context behind that exact move. So for an example, if a stock keeps testing the same resistance level over and over again, that can be a sign buyers are absorbing supply. And every time sellers try to hold that specific level, buyers keep coming back. And then eventually, if pressure builds enough, price breaks through and then expands higher. So that's when you'll start seeing those, big breakouts. And that's why patterns like, let's just say the ascending triangle are so powerful, because you have that flat, resistance level on top and higher lows underneath. So that pretty much tells me that buyers are getting more aggressive. They're stepping in, sooner and sooner. And when that resistance finally breaks, it usually leads to a strong move. Another common breakout setup is a bull flag. This is when price makes a strong move up and then consolidates in a tight range or slightly downward. And that pullback is the reset. So if a stock holds its gains, and then let's just say it breaks out of that consolidation, that can be the next leg higher. Since I'm talking about breakouts, I guess I can get into a reversal pattern. So a reversal pattern is exactly what it sounds like. It's a structure on the chart that suggests price may be about to change direction. Maybe a stock has been selling off for a while and starts to form a bottom, or maybe it's been running hard and starts to lose momentum at the top. For me personally, one of the most common reversal patterns that I personally use are things like the double bottom. So this is when price sells off, bounces, and then comes back down and then tests that same area again, but obviously fails to break lower. So that tells me that sellers are at least trying to push it down again, but they couldn't. And then obviously we got the double top. That's the opposite of a double bottom. Price pushes into resistance, pulls back and then tries again, that whole sort of thing. That can be a warning though, that buyers are losing strength and that the trend may be reversing lower. So that's double bottom and that's double top. Another major reversal pattern is the head and shoulders. We actually use this exact pattern in the Discord this week, and we got over 110% on a ticker symbol NVDA. That's when we used the head and shoulders pattern. We took it from, I believe, 172, and now it's currently at 166. But keep in mind, a reversal pattern by itself doesn't mean anything unless it forms in the right place. So if you get a bullish reversal pattern, right into major resistance with no volume, in my eyes, that's considered weakness. But if you get one after an extended sell-off, at a key support level with momentum, slowing down, then obviously that's a different story. And I see a lot of people lose money because they anticipate the reversal way too soon. They buy the first red day thinking, it's the bottom, or they short the first green day thinking it's top. And I'm not going to lie to you guys. I've been there plenty of times, especially in this current market where, Trump can say, 4 words and the market just goes right back down. We've all been there. But when the market is actually stable without all this, headlines and nonsense, driving it, this is where these type of patterns could help you actually along your trading journey. So for the next category, let's get into candle patterns. So we're going to start talking about the engulfing candle. So this is one of my favorite type of candle patterns. It's pretty much when a strong green candle completely covers the previous red candle. And that tells me that buyers are stepping in and then completely took control. On the other hand, a bearish engulfing candle is when a strong red candle pretty much wipes out the previous green candle. Next, we have the hammer. This is a candle with a small body near the top and a lower wick. As you can see, price pushed lower and then sellers thought, they had control. But as we know, buyers stepped in and then, pushed it back up. And when that happens as support, I realized that, especially after a pullback, it can be a strong signal that buyers are, beginning to step back in. Now, the opposite of an engulfing candle is the shooting star, quote unquote. And it's pretty much a small body near the bottom. And then you have that long upper wick. That means price push higher. I guess you could say buyers were in control. But then, sellers stepped in and pushed it back down. And when you see that near resistance, or let's just say after a run, it could signal that momentum is starting to fade. And I guess since I'm talking about engulfing candles and shooting stars, I guess we can talk about doji. Now, doji is a little complicated. I see a lot of people misunderstand it. But pretty much a doji is when price opens and closes around the same level. I guess you can pretty much say it's like indecision. So neither buyers nor sellers are in control at that moment. It's basically the market pausing and deciding what it wants to do next. On its own, a doji doesn't mean much, but at key levels, it can be super important based from my personal experience. Actually, for an example, if doji is at resistance after a run, that usually means there can be, a potential fade in the near future. And let's just say you have doji at support after a sell-off. That's usually a signal, for me at least, that there's a potential shift going to start happening. But remember, I'm usually, taking notes on doji when it's at support, which leads to my next category, which is support and resistance. If there's one thing I wish every trader actually knew about, it is support and resistance. And this is the most basic concept in trading, because everything on the chart comes back to price reacting around key levels. So let's get into it. So support is an area where price tends to stop falling and buyers start stepping in. And on the contrary, resistance is an area where price tends to stop rising and sellers start stepping in. So of course, to you guys, that sounds pretty simple, but support and resistance are not just random lines. They represent areas where retail have made decisions before. That's why price usually reacts around that same area. Now, the first thing I want you guys to understand is that support and resistance are zones. So they're not, to the exact penny, to the exact dollar, like most people you see when they do support and resistance. A lot of you guys draw one perfect line and then expect price to reverse exactly there. Like that's not how it works. The market doesn't work that way. Price, could overshoot, sometimes, wick through certain levels or test around an area before deciding, what to do, just like the doji candle that I explained earlier. The second thing is that the more times a level has been tested, the more important it becomes. So if price keeps bouncing off support, that tells you buyers are defending it. And if price keeps rejecting resistance, that tells me that sellers are, let's just say, active there once again. But eventually levels break, as we know. And when they do, that tells you something as well. So if resistance break and price, let's just say, can hold above it, that old resistance can become new support. And that's one of the most important ideas in trading. Same thing in reverse. Let's just say if support breaks, it can turn into resistance. And this is why retest matters so much in my personal strategies. A breakout alone is not enough for me, but if price breaks resistance, let's just say it comes back, and then continues higher, that's a much stronger buying signal for me. Remember, everyone has different strategies, but I'm just talking about my personal strategy. Next, let's get into trend lines. A trend line is pretty much a line that connects important swing lows in an uptrend or swing highs in a downtrend. And at least for me, it helps me visualize the direction of price and where that trend might continue or break. And if price is making higher lows, you can draw a trend line underneath those lows. And that line acts like a guide showing that buyers are stepping in at higher and higher prices. If price is making lower highs, you can draw a trend line above those highs to show that sellers are staying in control. One of the best uses of trend lines, for me at least, is spotting compression. So the way I personally use trend lines is pretty simple. I use them to understand structure, track momentum, things like, I guess, identifying key zones where price may react, but I never trade them blindly. For me, at least, I let price show me whether a trend line is actually being respected. For an example, I'll put up a screenshot here. We played Tesla, ticker symbol TSLA. We played that last week. And in that trade, I wanted to personally see a retest back at that $360 level. So as you can see on the chart, you had that one bounce earlier. You see the second bounce, and then this third bounce. This is where I wanted to see that reversal. So then we played puts, and then we were up 15% profit on that exact trade. It's up much more right now, but as you can see, I told the Discord that I wanted to be as transparent as I can. I don't like how the market is currently moving, so I'm just going to take the 15% and then move on. Did I miss on profit? Yes, but that's not the point. At least I feel comfortable in my own strategy. Now let's start going into MAs, or that's short for moving averages. A moving average is simply the average price of a stock over a certain period of time. So for an example, a 20-day moving average shows you the average closing price over the last 20 days. And then let's just say a 50-day moving average shows the average over the last 50 days. And then so on and so on. So the reason people use moving averages, at least for me, is because they help smooth out price action instead of staring at every little candle and getting distracted, from all the noise in the market. A moving average pretty much helps me see a bigger trend. But they don't have to be huge, like 20, 50-day moving averages. They can be, shorter moving averages like the 9 EMA, the 20 EMA, like the 9 EMA. So keep in mind, the longer moving averages like the 50, the 200 move slower and then show broader trend direction. So let's just say if price is trading above the 20 and the 50 moving averages, and those averages are, let's just say, slightly going up, they usually mean strength within that trend. But what I notice is I see a lot of beginner people, they get scared the second a stock pulls back. But if that pullback is into a rising moving average, that may actually be a normal part of the trend. So moving averages are not there to make decisions for you. They're there to help you read the chart better. And as we know, the cleaner you can spot the trend, the better your entries and exits and so on. This next one is actually one of my favorites. It's not my favorite, but it's one of my favorites. And it's RSI. A lot of people think RSI works like this. If it's over 70, they think, oh, you automatically should sell. Or if it's under 30, they automatically think, oh, I should buy it. But that's honestly just beginner slop, to be honest. RSI measures momentum, and it pretty much tells you how strong recent price movement has been compared to recent weakness. And it moves from 0 to 100. So typically above 70 is considered overbought, and below 30 is considered oversold. But obviously there's a catch to that. So overbought does not automatically mean price has to come down, and oversold does not automatically mean price has to bounce. In a strong uptrend, RSI can stay elevated for a long time. And in a strong downtrend, RSI can stay weak for a long time. So if you blindly just short every overbought or buy every oversold reading, you're gonna get smoked. So the best way to use RSI is not as a buy or sell button, For me personally, I use it for, like I said, measure momentum, spot potential exhaustion and understand whether price is strengthening or weakening. Hopefully you guys got value from this video. This is just part 1 of my full guide. If you guys want part 2, let's make sure this video gets to 100 likes and comment below what tools do you currently use or what tools do you see yourself using in the future. I break down all of these concepts much deeper inside the Discord, but for now, stay patient, stay disciplined, and I'll catch you guys in the next video.